In this video, we're going to talk about a comprehensive capital budgeting problem. And by comprehensive, I mean we're going to look at the individual predictions and subparts, if you will, or subcomponents to calculating free cash flow for the company. So we'll start with sales revenue. And again, with a basic description of how the data is worked. We have a basic prediction of sales in this case. We predict we're going to sell 20,000 units. But we're going to also apply some statistics, right? That the growth of this number is 2% and the standard deviation is 1%. Now you have to have a mean and a standard deviation in each box for the formulas to work. We'll talk about that here in a second. We also have the per unit price, and we also have the unit's project life. So as we go down through this unit, we start with, you can put in the year, obviously. And you can see here from 20,000, the growth is calculated based on 20,000 plus or minus with a 2% growth and a standard deviation of 1%. That creates the growth in units for year one, 330,000. Then that number is then adjusted, if you will. This number, 20,660, is adjusted for the next year's unit sales, if you will. So we end up with predictions. We have 6 years of predictions of net sales. The next thing that we would look at then is the cost of goods sold worksheet. Again, we have some numbers that we have predicted or have determined our maybe our current level, if you will, and then we adjust them for growth going across the border here. So we have now, here's the unit sales, direct labor, right? We know what that is. Again, it's a formula based on the growth rates up above. Direct materials, there's no indirect costs here. The fixed costs we know are fixed. So our total cost of goods sold going across the board is this bottom line here. We need to have something about selling and administrative worksheet. Again, here are the growth rates that we have. If you notice here, we still have to put 0 and 0 here so that the formula ultimately works. So we have some variables for selling administration, cost of goods sold. The next things we need to work on then are the assets that we need. So the first thing we want to look at is the working capital worksheet. What kind of working capital, current assets and current liabilities, do we need? Well, currently we have some values on our spreadsheet, on our worksheet, or our financial statements. So we know there's 20,000, 35, 15,000 is the current amounts. The next thing we have are our projected ratios with respect to days sales outstanding, days carrying inventory, and days payable outstanding. This could come from our current numbers, or they could just be the numbers we desire. We have 15,000 in cash, and we want cash to be a percentage of sales. So whatever sales are, cash will be 15% of that. So as we go down across the line, we find out our values for our net working capital going across the board here. And again, we only need it for 6 years. So we go out here. Here are the values that we expect to have in our working capital asset spreadsheet. We also need to incorporate what are the fixed assets that we need. We're going to buy 2 assets, $100,000 in a 3-year asset and $750,000 in a 5-year asset. When we incorporate that, you'll see that the asset shows up. Here's the values. Now here's the depreciation schedule for these assets. It's calculated for you. You don't have to do anything other than input the data here. That also then calculates what our net fixed assets will be on our balance sheet. Now, the other thing we have to do is determine what will the value of these assets be at the end of this project. So at the end of this project, we expect to be able to sell the 3-year asset for $20,000 and sell the 5-year asset for $100,000, which gives us a cash flow at the end here of $120,000. As we go down the list then, now we can start the analysis of the financial statements. Here's our income for the first 6 years of this project's life, right? We then flow down through. We know what the balance sheet will look like. Here's the balance sheet, right? Here's total assets. Here are the accounts payable balances. One of the things you'll notice is there's no equity section here, and there's no long-term financing. The reason for this is when we calculate net present value, the number that we use, that discount rate, is also the cost of capital, which is the average cost of financing projects. And that incorporates both the costs of debt and the costs of issuing and using common equity. So we don't include it in this analysis. That ultimately flows to our free cash flow calculations. And then we ultimately then have some basic numbers here for 4 of our primary capital budgeting technique numbers. So we have discount rates 13%, and our reinvestment rate is 15%. So you can see we have a positive net present value. 15.6 is greater than 13. 15.1 is greater than 15. And of course, the profitability index is greater than 1. So this is a good project. Again, the purpose of this project is to give you a feel for the complexity of predicting the individual components of capital budgeting.